Thanks for coming on. Catch-22 is a great way to describe it, isn't it?
It sure is. I mean, look, we are in a spot right now. I know the Fed is telling us that after the last press conference, Powell was pretty confident they were going to get the 2%, and he didn't see any inflation or stagflation. I couldn't disagree more. I mean, I think, look, we'll probably get some soft data on inflation maybe in the next couple of months. But overall, the trend's going to be higher. They have accumulated a massive debt issue, the largest debt bubble of our lifetime. And I don't see how it's mathematically possible to navigate a soft landing by getting inflation down to 2%. The reality is this, and no one really wants to come out and say this, the only solution to getting inflation down from where it is now to the 2% number is some type of economic destruction and demand destruction, and that would be a recession. Because if they cut rates, it's going to cause asset prices to go even higher.
Right.
So we believe our thesis is inflation is going to reaccelerate at the end of this year. 10-year note's going to be over 5, and we'll have some major headwinds going into 2025.
Yeah, and to your point, whoever wins in November is going to be planted a big plate, you-know-what, on January 1st, right? Because it's going to be a mess, and a lot of it will become unraveled by then. I think right now the government's been juggling the balls pretty well, trying to keep everything in the air. But I'll say this, that GDP miss combined with PCE about a week and a half ago, I think that finally they found out that there was really nobody behind the curtain pulling the levers, and that got a lot of people a little bit, concerned. Now, one miss on a jobs number and everything's fine again, and we want these rate cuts, it doesn't make any sense to me. And to your point about this debt problem, you know what? The easiest way to keep your growth numbers high and not slip into a quote-unquote recession is keep spending like with reckless abandon, right? And that's what we've done. We have spent so much money from the U.S. government to basically keep us out of that recessionary territory. And at some point in time, you're going to have to pay the piper, right? You can't do that forever.
That's exactly right. And look, here's what's going to happen, and it's already started. The capital markets will correct things for the government because they've now gotten to a level where our balance sheet looks like a third world country, and we're in a pretty dangerous spot from a spending and deficit perspective. We've not seen deficit spending like this ever in history. That's not a war, and history is a long time. So we have some true fundamental problems that can't be fixed by kicking the can down the road. And this is why we think regardless of what the Fed does, the capital markets will take over, and the bond market's going to call their bluff, and you're going to see, in our opinion, interest rates go higher. When we look out 6 and 12 months from now, we're telling our clients to be prepared for a dollar that strengthens and the bond market at the 10-year being well over 5%, because all this spending is inflationary, and it's killing hardworking Americans, and businesses are having problems in regards to what the cost is to run their businesses. So they've put themselves in a corner, and it's a lose-lose position whether they cut or don't cut. And this is why we've been buying commodities and things that are tied to inflation, because we want to profit from it.
Yeah, we've started to see a lot of that come into our markets, just some of the grain markets as of late. And anybody that's been short those things has seen the writing on the wall and covered their shorts too, because they know exactly what you're saying is true. And to that point of this spending, when we went through this the last time, I was actually old enough to remember 1980, 81, 82, when we saw Volcker. We always invoke him right now about what he had to do. He had to kill the economy to kill inflation, right? Short term. But the problem is we can't see rates do what he did then today, because there's one key component that people don't really say, and that's back in 1981 or 82, our debt to GDP, Eddie, was 35%. We're 125% today. They can't afford to kill inflation with rates right now. It's going to have to be something else. You got about 20 seconds. What do you think?
Yeah, look, I think they're going to end up cutting their target to at least 3%, because there's no way they're going to be able to get it to 2. That's our opinion. And we are heading towards stagflation. That's where we think we're going to be, because growth is slowing and inflation is not coming down.
I agree. We got that a couple weeks ago. Thank you very much. I love having smart guys like you on. Eddie Ghabour coming to us from Delaware. Thanks for being on the show.